This is level 2 of the CFA program, the topic on economics, and the reading on currency exchange rates, understanding equilibrium value. You might remember back from level 1 that exchange rates are a function of two variables. The relative strength of two economies, which of course leads to exporting and importing, and then the behavior of central banks. In order to get through this slide deck, what I want you to do is visualize the foreign exchange market, not as the electronic market as you and I know to be true, but I want you to think of it as a physical market. And in this physical market, there are just a bunch of tables. And on top of each of these tables is a pile of individual currencies. For example, let's suppose we're in the foreign exchange market between the US dollar and the Canadian dollar. And let's suppose that on this table we have 100 US dollars, and on this table we have 100 Canadian dollars. And let's further suppose that the size of the US economy and the size of the Canadian economy are pretty much identical. Let's further suppose that interest rates in the two countries are identical, and that inflation and expected inflation in the two countries is identical, and that the central banks for each country operate pretty much on the same page. Maybe they're best friends. Maybe they play at the same country clubs. Well, if that's true, then almost everything that we're going to look at in these learning outcome statements in the next moment is going to be totally irrelevant, because you have an orderly flow. If it's $1 for one Canadian dollar and interest rates and inflation are the same, then all of these equilibrium conditions are going to hold true. And so under those circumstances, we wouldn't have to worry about any arbitrage. Forward rates would be the same as spot rates. There would be no need to mark to market. There would be no arbitrage opportunities in either covered or uncovered interest rate parity. But of course, that's an extreme example that I just gave you. But what I want to do is relax some of those assumptions as we go through this slide deck, and you'll see the value of what this reading presents to us. And then look at that last one down there. I think this is probably a relatively important one. Forecast future spot rates of exchange. And then we'll move along to kind of the accounting treatment of the foreign exchange market. Notice this is called the balance of payments. Each country has a balance of payments, so we'll have to talk about how those balance of payments affects exchange rates. And then, of course, you have to talk about monetary and fiscal policy. And then, as you guys know, the CFA Institute likes to end these LOSs with, kind of a small, short LOS that really captures, maybe I don't want to call it a current event, but something that has the potential to be a current event. So warning signs of a currency crisis. So here's a quick recap. Exchange rates, of course, are just one currency in terms of another currency. Of course, whenever we go shopping, today I'm going to go shopping. We're having some chicken sandwiches tonight. And my wife said, hey, go get a nice tomato. So I'm going to go and I'm going to spend, let's say, $2 on a tomato. So that's $2 per tomato. But now in this case, with currencies, we have a currency in the numerator and a currency in the denominator. So look at that second diamond point, quoted exchange rate. And this is important. Notice that we have the price currency, which will be in the numerator, over the base currency, which will be in the denominator. And you'll see how important that is as we go through some of the math, because one or two of those LOSs asks us to calculate. But I want to make a comment here about what the two authors of this reading state early on in one of those early sections. They say something like, and I'm paraphrasing here, note, the reader ought to be aware that our notation and our use of exchange rates may be different from what the reader has experienced in the past. So it's important for you to look at that diamond point. Price currency is in the numerator, base currency is in the denominator. Make sure you have and use that convention throughout the exam. So there's just a quick example at the bottom of the page. Suppose that we have a US dollar per euro, and we're given a quote as 1.1813. So the euro dollar is in the denominator, the euro is in the denominator, so that's the base currency. U.S. dollar is in the numerator, so that's the price currency. Think of it this way, right? When I go to buy a tomato, maybe it's $2.10 one week, maybe it's $1.95 another week. So that numerating price can change, but the base currency, the tomato, or in this case the euro, is constant. The reading also makes a note to differentiate between a direct quotation, foreign currency as the base currency, and indirect quotation, in which the domestic currency is the base currency. But of course, just like on the floor of the New York Stock Exchange, and just like when you have markets throughout the world, there is a series of prices. One is called the bid price, one is called the offer price. Some people refer to it as the ask. I think this reading uses both terms, but most often it uses the offer price. And you'll remember it this way: the bid price is the price at which the dealer. Now, when I learned it back in the old days, I used the term broker in there just because bid price, broker, buy, those were 3 B's, and that's how I remembered it. But then, of course, as I learned a little bit more about this, it makes perfect sense. Bid price always has to be less than the ask price. Of course, the difference between those is known as the bid offer or the bid ask spread. And these are measured in percentage in points. So there's just a quick example at the bottom. If we're looking at the US dollar and the Great British Pound, then we've got, what is that, 3776 and 3778. So if you subtract those two, you get 2 pips. Look at that last circle point. That's important there. Spreads are more narrow in the interbank markets. How about this one? Factors that influence the spread quoted by the dealer. And of course, liquidity is one of those first answers, has to be one of those first answers. If there are lots and lots of a currency sitting on one of these tables, and there's lots and lots of another currency sitting on another one of those tables, well, then the bid offer or the bid ask spread is probably going to be more narrow, because anybody looking at this says, oh boy, if I demand it, there's a whole bunch there. And if I'm supplying it, there's a whole bunch there. So that should make perfect sense. Size of the transaction, of course, if you trade for $1 billion US dollars per Canadian dollar, and you do it for 100, you'll probably get a larger spread for the 100. And then the third circle, or third diamond point, I thought was interesting that the authors would bring this up: relationship between the dealer and the client. Dealers can quote favorable rates based on ongoing business relationships, which of course means that if I'm just Jim Nobody and I go to the dealer at a financial institution and say, hey, I want to buy 10,000 Canadian dollars, they'll give me a rate. But if let's suppose you're a super important foreign exchange client, and maybe like let's say Coca-Cola, and you have generated all these cash flows in other currencies throughout the world, you'll probably get a better, more narrow spread. That makes sense. A couple of other things there. Currency pair involved. Of course, there are very liquid currencies: US dollar, British pound, the euro. So they have lower spreads. Time of day. I really thought this was interesting. I can't imagine the CFA Institute saying something like, hey, during the course of the day, when is the US dollar and the British pound most liquid? Now, if you actually go and look at the reading, it tells you that there's an overlap between London and New York trading sessions between 8 a.m. and 11 a.m. That's New York time. And then somewhere around 7 to 8 p.m., that's for time way over on the other side of the world, maybe in Japan or China. But as I'm looking at this LOS as a potential question, I can see where the CFA Institute might say something like, okay, here's a couple of countries, maybe they'll make up some countries, and here's their time zones. Which time of day would result in the spread being at its most narrow, and just go find the overlapping period. And then, of course, market volatility. We know this back not just from level 1, but we know this from our undergraduate days and way going back to kindergarten. When prices do this, right, instead of just this, well, then there's more risk. We can just call that a general risk. And so not only are the dealers going to protect themselves by widening the spreads, but it'll probably spill over into the intermarket. The interbank market as well. All right, here's one of those LOSs that has the action word calculate in it. So triangular arbitrage. Oh boy, let's go ahead and first talk about this concept of a cross rate calculation. So notice what we give you in example 1. So we have US dollars per euro and then US dollars per Australian dollar. And from those two quotes, one can compute the quote between the Australian dollar and the euro. And so you do just a little bit of math. The convention, it seems to be the convention in the reading to go ahead and multiply every time, but sometimes you're going to multiply by the number given. Sometimes you're going to multiply by the reciprocal, as in the case here, just making sure. Notice that we have US dollars and US dollars in the numerator and denominator so that they cancel each other. I always teach my students either to multiply or divide, but multiplying by the reciprocal is still going to get you the correct answer. A couple of arbitrage constraints here. These are probably good sentences to memorize, and then as we go through the slide deck, you'll probably say, oh yeah, that makes sense. The bid quoted by a dealer cannot be higher than the current interbank offer. Of course, that makes sense. The cross-rate bids quoted by the dealer must be lower than the implied cross-rate bids. Okay. Steps in determining triangular arbitrage. So let's just start with one currency, convert it to B, then convert it to C, and then convert it back to A. Boy, that's a super simple example. Let's do a little bit of math here for this one. How about those quotes down the left-hand column between the Australian dollar and the US dollar, and then we'll throw the Canadian dollar in there as the third currency. So look at the bottom math very quickly. Check whether there is an arbitrage opportunity. So when you multiply 10723 times, by one, yes, that's correct. When you multiply 10723 by 12505, you don't get 1343. So there is an arbitrage opportunity. So let's go over to the right-hand column. What we're going to do is sell US dollars for Australian dollars. And let's just start with a randomly selected 100,000 US dollars. So we end up with 134,230 Australian dollars. Convert that to 125,180 Canadian dollars. Convert that back to US dollars of 100,106. And so there's an arbitrage profit of 106. Now, of course, if the institute gives it to you in this form, then this is a super easy kind of a calculation. But notice the LOS. The LOS doesn't read, hey, do all this given just simple quotes. They say given bid offer quotations for three currencies. So let's go ahead and work through a more likely example that's going to show up on the exam. But here's the deal. What we're going to do is exact same thing here, but we need to worry about the bid and the offer because sometimes we're buying and sometimes we're selling. Now, of course, the big question that you guys should be asking yourself as we go through this triangular arbitrage, notice that first step. It says something like, oh, let's just start with 100,000 US dollars. Well, we're kind of assuming that we have 100,000 US dollars laying around. Now, I'll get back to that later on when we do, maybe some covered interest arbitrage. But for now, let's just assume that we have $100,000 laying around. All right, notice what we have down the left-hand column. So again, this is an example with bid offer quotations, and this is identical to what's happening in this particular LOS. So we have Bank A, Bank B, so there's the interbank market, and then we have a dealer quote. And note that in the middle and the far right column that we went out to a number of decimal points, 0.5000. So that's 5. I don't think you can say that's 5 significant digits. I forget what grade I learned significant digits in. But the reason that we put those 5 decimals in there is because the reading uses 5 decimals, and you need to go out to 5 decimals because over the years these spreads have narrowed all the way down so that you need those. So my point is, be prepared to work through the math with all of those numbers to the right of the decimal sign. All right, so look at the very bottom row, computed cross rates, and there's the math down below. And notice there's the convention of multiplying by the reciprocal. And so note that those computed cross rates are not equal to what the dealer has quoted, right? So an arbitrage opportunity exists. So let me go back. We're going to do these 3 quick steps right here. We're going to do these things right here, but we need to be super careful because we have bids and offers. All right, so where I am here, steps for triangular arbitrage. So let's go ahead and, hey, if we could come up with $100,000 on our own in this example, why can't we come up with $1 million US in this example? So let's go ahead and sell US dollars, $1 million to Bank A to buy Mexican pesos. So if you do the math over there, you get 19.9 some million. What we're going to do is we're going to use the ask rate because it is the price we pay when buying those Mexican pesos. Then we're going to take those Mexican pesos and we're going to sell them to the dealer to buy Canadian dollars. We're going to use the reciprocal of the bid rate in the original quote, right? So we're going to end up with 259 Canadian dollars. And then we're going to take those Canadian dollars and we're going to convert those over to US dollars, and we ended up getting 1,007,548. So subtract that from our original 1 million and we get a triangular arbitrage profit of 7,548 US dollars. Now, let me give you a little hint here. I'm going to toggle back and forth between these 2 slides. Is that, remember now, for triangular arbitrage to work for someone like me or someone like you, whenever we transact with the dealer, we're always going to get the worst price. So if you're confused of whether to use the bid or the offer, always make it so that the answer that you get is the least, is the lower of the 2. That's one of those shortcuts that I learned over the years. So there's the profit of 75.48. Now, how about let's move on to an LOS that asks us about spot rates and forward rates. So let's go ahead and get back to that table that I described in the introduction. So we have a pile of US dollars here, 100, and we have a pile of Canadian dollars here. There's 100 in a 1-to-1 exchange. So think about how exchange rates are going to change. Let's suppose that here I am living on the East Coast, and I know that somewhere in Canada they make great ice cubes to put in my iced tea. So let's suppose I take 20 US dollars and I lay it on the US dollar table. Now the US dollars, there are 120 of them, and I go over to the Canadian dollar table and I take out 20 Canadian dollars and I go buy the ice cubes, right? So now there's a mismatch between the amount of currency on each of the tables. So now we have to start thinking about what's going to happen with that mismatch. And the clear answer that I'm going to give you here to end this transaction is that somebody in Canada is looking down here on the East Coast and saying something like, hey, I love Hershey Kisses. I'm going to go buy some Hershey's chocolate. And so they come and they put 20 Canadian dollars on the pile, and they come over to this pile and take 20 US dollars out of that pile, and then they come to Hershey, Pennsylvania and buy their chocolate. So we're back to 100 and 100. So notice imports and exports are the same. Now, let's suppose that exporting and importing is identical, right? So we're still at 1-to-1. But what did I say in that original example? I said that interest rates are identical in both countries. Well, now let's suppose that for some reason that it's not. Suppose for some reason in Canada, the interest rate that's being offered on a money market account is 40%, and it's only 10% in the United States. So now what's going to happen? Now, there are a lot of people in the United States who are going to go to that table and pile up the dollars, take out Canadian dollars and go get 40% in the Canadian money market, right? So, all right, so there's an imbalance here, but how is there going to be a rebalance? Well, remember now that there are a lot of Canadian investors that are going to say, wait a minute, I can come to the US and borrow at that lower rate, let's say 10%. So those Canadian investors are going to pile stuff on that table and take out and come to the US and borrow those dollars. So what happens about these things? Well, sooner or later, both groups of people, whether it's the importers and the exporters or the borrowers or the lenders in this market, are going to realize that there's a future transaction that's going to be required. So this is the forward exchange market. So these people here, they're going to make a pit stop somewhere in the middle and say, you know what, we know we're going to do something in the future. Let's go ahead and trade in the forward market. Let's agree to exchange these currencies, let's say in a month's time or in 2 months' time or 6 months' time, whatever that time period is. All right, so now think about what's going on here. You have the spot rate of exchange moving, you have interest rates moving because you have borrowers and lenders in both markets. Well, when you have all that stuff going on, it's never going to be a perfect scenario where they equibalance. Is that a word? I don't know that that's a word, but I bet you understand it. There's equal balance between interest rates and spot rates and then forward rates of exchange. So there's this possibility then that we're going to have a forward premium or a forward discount. In fact, we're almost always going to have a forward premium or a forward discount. Look at the shaded area at the bottom. So if the forward rate is greater than the spot rate, then that difference is known as a forward premium. And then, of course, if the opposite holds true, it's known as a discount. And so really what happens in that forward market is a function of, are you ready for this? A function of what's happening with imports and exports. And then at some point, you know, like I may have gone to Canada and bought those ice cubes and said, man, this is the greatest thing ever. I'm having a party in a month. I want to have a big old pile of those ice cubes in a month. So I may go to the forward market today so that I can lock in that forward price. Similarly, those people in the United States are looking up at Canada and saying, man, I want to invest. I want to invest to get 40%. Well, that's going to pay off. And in a month or 6 months, I'm going to want to convert those Canadian dollars back to US dollars. So those investors are going to the forward market. So you have all of this stuff that's going on. And remember, this is in the short term. Now, sometimes short term means today, like in the spot market, but sometimes short term means a month from now, which is in the 1 month forward market. So you have all of these factors that are going on, all of these variables that are contributing to what's going on in all of those markets. All right, so let's just make sure we're up to speed here, right? Spot rate of exchange, immediate delivery, usually 2 days. Forward rate of exchange, that's for 30 days or 60 days or 90 days. Now, this relationship that I was just describing can be summarized by this equation here. What's a reasonable, look, here I'm Jim and I'm an ice cube lover and I'm having a party in a month. Well, how much am I going to pay in the forward market for those Canadian dollars so that I can buy enough ice to satisfy all the people that come to my party? Well, this interest rate parity equation here tells us that this is really cool, right? That this is a great relationship. So we start with a spot price, right? Now remember that the forward market is a derivative market. And so the derivative has to be a function of the underlying asset. So that's why there's an equal sign there, right? Forward rate is equal to the spot rate. That makes perfect sense. And notice it's going to be adjusted by the difference in interest rates between those two countries, like 40% over, what did I say, 10%. So we need to do all that stuff inside of this model to come up with a reasonable estimate of that forward rate. One quick note about numerators and denominators here. Please be aware that the foreign currency is in the numerator, the domestic currency is in the denominator. So let's take a look at just a super quick example here. Let's suppose we have US dollars per Australian dollar, so that's about 75 cents, right? We have US rates 3%, we have Australian rates 5%. So let's go ahead and do a couple of things, right? Let's go ahead and say, all right, what's the forward rate going to look like? And then let's calculate a forward premium or discount. All right, you ready for this? So here we go. Let's start with that 74.88. That's the spot rate. And let's adjust that by the relative interest rates. Now, here's another shortcut that you're going to remember. Notice that the domestic currency is in the denominator, right? And what we're going to do then is we're going to put that interest rate in the denominator, right? So we have that spot rate is US dollar per Australian dollar. So the Australian dollar is in the denominator right after the per. So throw that Australian interest rate in the denominator. That's an easy way to remember this. And then, of course, you have to adjust it for time. Boy, on the exam, don't be surprised if the institute gives you just a 1 year. So there you just have a 1.03 divided by 1.05. But of course, you need to be prepared. You need to be prepared for the adjustment for year. So there's our forward rate, 73.80. And that gives us a discount. What's the difference there? 0108. Now, of course, today, when I go into that forward market and I agree to sell US dollars and buy a bunch of Canadian dollars so I can buy the ice cubes so I can have a great party, let's suppose that, what did I say, a month from now? Let's suppose that during the course of that month, I decide that I don't like any of my friends and I don't want to have this party anymore and I want to cancel the party, but I still have that contract. So it's one thing calling my friends saying, you know what, I need new friends, you guys are out. It's another thing calling the bank and saying, hey, you know what, I changed my mind on this forward contract. Well, the bank is going to say, hey, Jim, you can change your mind whenever you want to, but you are going to have to pay to get out of this contract. And that's what this marking to market is, the value of a forward contract. And all we're going to do is say something like, are you ready for this? All we're going to do is say, all right, and let me pick a number of days. Suppose I decide this, what did I say, 30 days? Suppose on day 21, I say, I don't like my friends. I want to get out of this contract. Well, then what I'm going to do is I need to find out what the value of that contract would be on that day, 9 days until 30 days, and then I'm going to see where I am. So notice the embedded diamond point. It is the profit or the loss realized from closing out a position at current market prices. And of course, the value of a forward contract has to be zero at time zero, right? I mean, no one's going to want to pay to get into the contract to automatically be a loser or to start out as a loser. So it's at zero, and then of course, well, what happens? Spot rates go like this, right? Interest rates go like this, and the value of that contract is going to change. So, I mean, let's suppose that, what did I say? There was an even exchange between the US dollar and the Canadian dollar at time period zero. Well, after 21 days, maybe that's 1.2 US dollars per Canadian dollar. And maybe the interest rates, instead of being 10 and 10, maybe they're 40 and 5 or 40 and 10. So now those input variables have moved so that the value of my position has changed. And so there's a good old formula at the bottom. And so notice all we're doing is taking the difference of those two contracts, the original contract and the one at time period 21. And of course, it's a derivative, so we have to multiply it by the notional principal or the contract size. So remember, a lot of these forward contracts, they're over the counter, so they're not standardized. So that contract size, it could be 100, it could be 1,000,000. Probably not going to be 1 trillion, but you never know. And then we divide by 1 plus, So we're just taking a present value there. So here's a super quick example. 100 million. What did we start out? We started with 100,000 and then we went to a million. Now we're way up to 100 million. So we have gotten wealthier and wealthier as we have gone through this slide deck. All right, so 30 days have passed. Spot rate is 2445 and 2450, and then the 60-day forward is a plus 140 and a plus 150. That's bid and offer. There's a 5%. 60-day Canadian dollar interest rate. What is the mark-to-market value in Canadian dollars? So that's important. So all we're going to do is figure out that forward bid price. So take the 12445 plus the 140. Let's just make sure we do that right. Yeah, 2445 plus the 140. Those are the new bid prices. So we get the 125.85. And we're going to use that 5%, 60 days, right? 100 million. So we do that math and you get 2.7 million Canadian dollars. Now, how about these international parity conditions? So let's take a step back, and instead of looking at the foreign exchange market just as the table of US dollars and Canadian dollars, now we have US dollars and Canadian dollars and Mexican pesos and euros and Australian dollars and all these other currencies. So we have a whole bunch of tables in the room. Now, what's the likelihood that each one of those tables is going to have 100 of that currency? And the answer, of course, is that's never going to happen. The next question is, what's the probability that each country is going to have the same interest rate and the same inflation rate? And the answer, of course, is that's never going to happen. So what we need is these equilibrium conditions. We need parity conditions so that arbitrage opportunities are unavailable. The last thing that we want is when we're buying ice cubes or we're coming to the United States and borrowing at that low 5%. The last thing that we want is somebody over here who's always coming to the market with some cash, whatever that currency is, and leaving with more and doing nothing more than taking advantage of, disequilibrium or market imperfections. All right, so these international parity conditions, these things hold. Think of them as equilibrium between and among all the stuff that's going on. And what did I say to you? What did I say to you early? That exchange rates are a function of relative economic strength and the behavior of central banks in determining interest rates. So think about the flurry of all of that activity, and it's going to be difficult for us to wrap our arms around this. We'll see that here in just a minute. So international parity conditions. Do you need this definition? This is what I have been talking about now for a few minutes. Interrelations that help determine long-run fluctuations in exchange rates. Okay, I can live with that one. Let's go ahead and start with this interest rate parity, and the covered part here, I'll tell you about that in just a second. A no arbitrage condition in which a foreign money market instrument is completely hedged against exchange rate risk. Completely hedged, meaning that it's using the derivative, it's using the forward contract. And so think about it this way. Here I am in the United States. I convert that to Canadian dollars. I go and invest it in some Canadian money market instrument. I hedge that with a forward contract. So now remember, this Canadian money market interest, can I say this? It's going to be risk-free. So I know what the future value is. So I take that future value and I sign a forward contract to sell all those Canadian dollars back to US dollars, right? And so the idea is that if I have to borrow this money, today I have to pay an interest rate, and I'm going to earn on my Canadian investment, and then the exchange rate ought to be set so that I can't take advantage of market imperfections, and then that ought to give me enough of a return just so I can pay off the loan. So the covered interest parity means that we're using a forward contract to cover that position. So notice that we have in bolded there, completely hedged. And let's read the last part of that sentence. So what did I say? It should give the same return as a domestic money market instrument. I used the example of a loan, but it could be money market as well. Now, of course, I don't have to use that forward contract. I can say, you know what, I'm smarter than everybody else. What I'm going to do is I'm going to invest in those money market interest instruments throughout the world in which I know the currency is going to move in my favor. So I'm going to get a return on my money market investment, and then I'm going to get a positive return on my unhedged currency investment, so that when I convert them back to US dollars in a month or in 6 months time, I'm going to have money being thrown all over the place, right? So uncovered interest rate parity, the expected return of the unhedged currency investment must be equal to that of an equivalent domestic currency investment. So I'm uncovering, I'm not using a forward contract. But what that means then is that all the stuff that's going on in the spot market then must be influential in the forward market, even though we're not using a forward contract, and the difference of those two interest rates. So look at that arrow point. Assumes that if there are different interest rates in two countries, which we know there are going to be, the spot exchange rate would adjust to compensate so that condition holds, right? So the percentage change in the spot rate has to be equal to the interest rate differential. Now, forward rate parity, that's the simplest of all equations that you'll ever get. Forward rate parity tells us that the forward exchange rate is an unbiased estimator of future spot rates. Now, remember from your statistics days, an unbiased estimator, it doesn't mean that it's a perfect predictor. In fact, it's not going to be a perfect predictor. But the term unbiased, at the risk of offending you, let me just remind you about these unbiased estimators. So you have, can I do this? You have a big old population, right? And so that population has a mean and a standard deviation and anything else you want to use in there. And then you take a sample, and that sample then has a distribution, right? It has a mean and a standard deviation. And so unbiased simply means that when you yank out that sample from the population, that distribution is the same as the population distribution, which means it has all those same kinds of parameters in there. So an unbiased estimator just simply means that there's no skewness in one of the distributions that's lacking in another. All right, how about the LOS on? Let's go ahead and look at some of these parity conditions. So let's start with purchasing power parity. And I remember my undergraduate professor giving me this example back in 1982. He said to the class, hey, if you went and bought a Big Mac here in the United States, how much would it be? And boy, I have to scratch my head. How much was a Big Mac back in 1982? I don't know, 50 cents? No, 25 cents, I don't even know. But he said, look, if you take that 50 cents and convert it into Canadian dollars, you ought to be able to buy a Big Mac in Canada. That's the absolute version of purchasing power parity. Now, it's not just simply Big Mac in Canada over Big Mac in the United States. It's notice what we have written in bold there, the ratio of the national price levels ought to tell you what that spot rate of exchange is. And I remember thinking to myself as I was sitting in class, but you'd have to be awfully hungry to go to Canada just to buy a Big Mac. All right, so this absolute version of purchasing power parity, this is a really good starting point. But what we need to do is step up our game a little bit and say, let's worry more about changes rather than absolute value. So relative version of purchasing power parity looks at the difference between the foreign and the domestic inflation rates, right? So in the absolute version, we just have a ratio of price levels. Now we're looking at the difference, the inflation rate differential, and that's the relative version. And the reading does mention ex ante versus ex post. And so ex ante, just remember that's expected inflation. Ex post means post means it already happened. All right, how about this Fisher effect? This is a super easy one. It just tells us that the nominal rate of interest, like the rate that we have to pay on a mortgage loan, it has to be a function of the real rate of interest. In other words, remember how much better off you are at the end of an investment time period than you were at the beginning. And at the risk of offending you, let me just give you a quick example. Let's suppose that you have $1 today and you're deciding on whether or not to invest that dollar at, let's say, 10% or buy a loaf of bread for $1. Well, if the bank is offering you 10%, you could go and put that dollar at the bank, and a year from now, you'd have $1.10. But if you think a loaf of bread is going to cost you $1.10 a year from now, well, then your real return is zero, because you can take the dollar today and buy a loaf of bread, or you can take the $1.10 a year from now and buy that same loaf of bread. Not that same loaf of bread. It would be moldy if you waited for a year, but after a year, you'd buy a loaf of bread. So that real return would be zero. So therefore, the bank has to offer you, let's say, 20%. So you get 20%, so you have $1.20 a year from now. You buy the loaf of bread for $1.10, and you have 10 cents. That's a real return. So you have to take that real interest rate plus the expected inflation rate to get that nominal rate of return. And then, of course, you can extend it to what we're talking about here with the foreign exchange market and these tables of currencies, all spread all over the room. What we need to worry about is the difference between the expected rates of inflation and the difference between the nominal interest rates. So you have Fisher domestically and then Fisher internationally. One pretty side note here, Irving Fisher was kind of like the very first super popular economist, and his advice was sought after for a long, long time. He became super wealthy, but as you may know, about a week before the stock market crash in 1929, he made an announcement that said, it appears as if we are headed into a time period in which high stock prices are permanent. And of course, he lost most of his family fortune in the stock market crash and the Depression. So remember Irving Fisher the next time you read in the Wall Street Journal or read in some other newspaper. Do you guys even read newspapers anymore? I still read the Wall Street Journal every day. Or you watch people on television when they say something like, oh yes, this is the new normal, new prices are high, or whatever it is. Be aware, because, this stuff has been around for thousands of years, and the fundamentals are not going to change. And this is really kind of our task as financial analysts, to take all the stuff that's going on and reduce it to a simple economic form so that we can make predictions and serve our clients in the best manner possible. All right, this LOS asks us to describe relations among the international parity conditions. So look at that first diamond point. So this is what I was saying to you earlier about all of these variables changing. So look at that. Let me read that to you. Most of the international parity conditions do not hold over short time periods. All right, so let's take a deep breath. And your first thought should be, all right, Jim, why am I wasting my time studying all this stuff if this is not going to help me next week? But you know as well as I do that when your client comes to you as a 30-year-old or a 40-year-old or even a 70-year-old, you're in it for the long term. You're saying to your client, all right, let's figure this out over 10 or 20-year periods or 50-year period, whatever it is. So what we're going to use these parity conditions to help us understand the interaction between and among all of these input variables over the longer term. And that's why we bolded the extended time periods. All right, so notice what we have in the boxes below. I'll probably just memorize these things. If ex ante PPP holds and international holds, then uncovered interest rate parity will hold. Uncovered, so that's an important one. When the Fisher effect holds, then the international Fisher effect will hold as well. And that makes sense. But let's talk about this orange one here. Assuming that both covered and uncovered interest parity hold. All right, so let's think about what that means. The covered means forward markets, right? And forward contracts. The uncovered means, all right, expectations about future spot rate movements. So if those two are in sync, then forward exchange rates will be the unbiased predictor of future spot exchange rates. So as good financial analysts, we need to take a step back and say, all right, covered and uncovered, when are those conditions going to hold? Oh boy, that's a challenge. Here's a really good illustration about what I'm referring to here in terms of the relationship among all of these conditions. And so notice in the middle, you have this uncovered interest rate parity, which doesn't use a derivative. And then surrounding that, you have changes in spot rates, you have changes in inflations, you have changes in interest rates, and then those are kind of summarized over there on the far right, forward premiums or discount. And so if I were you, I'd get out my phone, take a picture of this and have it on your phone so that you can look at it whenever you have a moment. But this one here is the challenge. Remember when you watch the Olympics and the gold medal winners, they never say to you when they're being interviewed on television, they never say, oh, this was the easiest thing I ever did. They say, you know what, since the moment I was born, I was training to, run fast or jump high or throw a ball in the swimming pool or whatever it is that these unbelievable athletes do. They always note that they are hard workers. And this is the hard work of financial analysis, of recognizing that over the short term, we need to just kind of close our eyes and hope that nothing bad happens, but we'll probably use some derivatives in there to hedge. But over the long run, we can reach our arms around this problem and help our clients achieve their long-term goals. I mean, we're never going to have a client come in and say, hey, I'd like to make 39% in the next month in the foreign exchange market. We're never going to say, oh, sit down, I know how to do that. So this is a great link here, this next LOS. So how are we going to forecast these future spot rates of exchange? We know about unbiased estimates. And look just quickly in the gray shaded area. When we get to the reading on equity analysis and equity valuation, we are going to look at a couple of different ways to compute a premium. And we're going to look at something called the build-up model. And I think we did a little bit of this back in level 1, but we're really going to look at it here in level 2. And this is kind of a build-up model. We're going to start with a nominal yield spread. What's the difference between the Canadian interest rate and the US interest rate? And then what we're going to do is we're going to add the difference between the expected exchange rate. So we got that yield spread. What's going to happen in the foreign exchange market? And then we're going to add that forward premium or discount. And that's going to get us our expected change in the spot rate. So think about what this means. The first part to the right-hand side of the equal sign, nominal yield spread, what we need to know is we need to know all sorts of things. But primarily, we need to study central bank behavior and what the central banks are doing to either increase or decrease interest rates. Then we need to be a pure economic analyst so that we know, expected national exchange rates. So that has everything to do with the relative power and productivity of each economy. And then, of course, we need to look in the derivatives market. My dissertation chairman told me before I wrote my dissertation, he said, Jim, the more you know about derivatives, the more you know. And he was right. All right, how about a carry trade? This is what I was talking about earlier when I was saying, okay, Canadian interest rates were 40%, US interest rates were, 5 or 10%. So a carry trade involves taking a long position in a high-yielding currency, and a short position in a low-yielding currency. Now, of course, this interest rate parity is going to tell us that high-yielding currencies will, of course, depreciate, low-yielding ones will appreciate. Now, what we know is that this is probably not going to happen in the short term, and that short term might even extend to the medium term. So we're going to try to use what we understand about carry trades for a long-term understanding. So look at that last circle point. High-yielding currencies do not tend to depreciate. What did that Olympian say, gold medalist? This is not the easiest thing that we've ever done. So we need to worry about what actually happens versus what these parity conditions are going to teach us. All right, let's take a look at a quick carry trade. There we go. There's $1 million. This time we're going to borrow $1 million. We're going to convert it over at a spot rate of 1.3. Then we're going to invest in these bonds in this foreign country that are yielding 7, right? So we borrow at the 5 and we invest in at the 7. Those bonds mature then for, what is that? 1.391 million. So that's the simple part there. Now remember that when we do the covered interest rate parity, we're probably going to invest in a risk-free security so that we know exactly and precisely what that future value is. But with uncovered interest rate parity, we're not using the forward contract. So we could, we just decided country-wide denominated bonds, but that could be almost anything, right? So we get 7%. Now, of course, that almost anything, if it includes stocks, then, that even that's a riskier proposition. Let's see, we're going to convert that back to US dollars at the, notice the spot rate was 1.3, and so we say that the pricing currency depreciates to 132, so we get 1053. And that 132, that could be some other number, right? We're saying if uncovered interest rate parity holds, then that's going to be somewhat of an equilibrium exchange rate at some time in the future. Subtract out the 105 because we borrowed the $1 million at the 5%. So there's our 0.003 million of profit with this carry trade. Now, let's go ahead and say to ourselves, hey, this sounds like a great idea. Why don't we go out and do it? All right, look at the bottom diamond point. Carry trade strategy can and will most likely miserably fail during turbulent periods. And so this is really the question. How do we determine what is turbulent and what is low volatility? Look at the green diamond point. Carry trading gives positive returns during low volatility periods. Now, look at this example that we came up with here. And this is similar to the one in the reading that, this is over a year's period. So how on earth can you expect the currency to remain low volatility over that time period? All right, let's switch gears and look at the balance of payments. So what did I say to you when we looked at those LOSs initially? That balance of payments is just kind of a way that governments keep track. It's kind of a balance sheet, but don't call it a balance sheet. It's kind of an income statement, but don't call it that. So balance of payments used to track transactions between a country and its international trading partners. All right, so that makes sense. Two accounts. There's the current account, which is exactly what I was talking about with the ice cubes and the Hershey chocolate bars, the exporting and the importing. So this is the current account. So you can have a surplus or a deficit. Of course, if we're exporting more than we're importing, that's called a surplus. But of course, it doesn't have to be just ice cubes and chocolate. It could be some kind of a tax service, or it could be some kind of a dividend payment or some kind of a unilateral gift. And then the capital account, that's how I learned it, but the reading also uses the term financial account. This measures the flow of funds for debt and equity investment into and out of a country. And so if one country has a current account surplus because exports are going out more than imports are coming in, then it has to have a capital account deficit. Yeah, how about flows in the balance of payments account and how they impact currency exchange rates? So let's try to get a sense of what we're doing here. In the first half of the slide deck, we tried to use those parity conditions so that we can predict exchange rates at some time in the future. Now we're going to look at the government's financial statements, and we're going to say, okay, what can we learn from those financial statements that will help us predict exchange rates? Or alternatively, how do exchange rates influence what's going on in those financial statements? All right, so a couple of different channels here. As they're known, a flow supply and a flow demand channel. So a country that exports more than it imports, right? So we're exporting. will have an increased demand for its currency, resulting in a currency appreciation. And this makes perfect sense that if we are exporting more, then what that means is that other countries are coming to the table that's filled with US dollars, and they're taking those US dollars out. So the supply of US dollars is falling, which means currency appreciation. Now, on the other hand, the similar example, but let's call this the portfolio balance channel, a country with a trade surplus will have more of a deficit in the country's currency than it wants, right? The table of US dollars is shrinking, right? But the table of Canadian dollars, there's 1 million Canadian dollars there. So who wants all those, right? So this puts a downward pressure on the Canadian dollar country's currency. So you have this on both sides. And this is why I think this is so interesting and why I relate it to the accounting. I want to say, remember in your accounting days, now we didn't have to do this in CFA stuff, but in the accounting days, when you did a journal entry, you had to debit something and credit something. And that's the way I view the flow channels and the portfolio balance channels. One is a debit and one is a credit. And then, of course, we can't even begin to talk about exporting and importing and all this kind of stuff about debt. So for a country that runs persistent deficits, it will be indebted to foreigners, and ultimately its currency will be depreciated. Okay, so we've got countries borrowing in this market that's going to lead to change in the value of the currency. Now, I like this one here, the capital account, which, what did we say back here? Measures the flow of funds for debt and equity into and out of a country. All right, so this will have a more immediate effect on exchange rates relative to the current account balances. So remember, those imports and exports, those things going back and forth, they're going to have an impact, but the capital account is going to have a more immediate effect. And then there's a section in here on emerging markets. All right, so what happens when we have countries like US and Canada who look at emerging markets out there and say, okay, maybe we want some goods and services from that emerging market, but maybe we want some of their debt and equity. All right, so what are these conditions? Appreciation of emerging market currencies, right? We don't want to invest in a weakening currency. A great buildup of external debt, boy, that doesn't sound like a good thing. Overinvestment in risky projects. I'm not sure how we can define risky projects, but I'm guessing that if you read the vignette that the Institute crafts, I'm guessing you'll be able to determine that it's a risky project, and then market bubbles as well. All right, how about monetary and fiscal policy? So let's go ahead and throw this in. What are central banks doing here? And then, of course, how do central banks behave with the legislative branch or bodies inside of that particular country? So the reading starts with the Mundell-Fleming model, and this describes how both fiscal and monetary policy changes are going to, are you ready for this? Impact the interest rates and GDP, which is the measure of the strength of an economy, especially changes in GDP, which then leads us back to everything that we talked about regarding interest rates and relative interest rates, meaning those interest rates differentials between and among countries. So the impact of interest rates and economic growth and how they're going to impact both the capital and the current accounts, and what their impact on exchange rates might be. So once again, we're taking a look at the fundamentals and saying, hey, let's go ahead and try to predict exchange rates. Now, what the reading does for you is the following. It divides these outcomes into two capital mobility possibilities. So if capital is very mobile, we call that high. If there's no mobility, we call that low. So look for high or low mobility. Look for that terminology in a vignette. And then the question is, okay, what is the central bank doing? And then what is the Congress doing, or whatever, Parliament, or whatever it's called in that particular country? All right, so what I want to do is I want to go ahead and look at the middle of this table. So let's look at monetary policy and fiscal policy. Think United States here. Suppose monetary policy is expansionary, which means that the Fed is lowering interest rates and it's out there doing all sorts of stuff in capital markets, just flooding the market with the money supply. But the fiscal policy is restrictive. Maybe Congress is saying something like, oh, we don't want to spend any money this week, or let's go ahead and raise taxes. All right, so when that happens, this will result in a domestic currency depreciation. If the opposite holds true, restrictive and expansionary for monetary and fiscal policy, then we have just the opposite. So those are the 2 points that I would remember for high capital mobility. And then on the other hand, low capital mobility results in domestic currency depreciation and appreciation when the central bank and Congress are agreeing with each other. So I would get out my phone and take a picture of this table and memorize it. Now, how about monetary model here? So unlike the Mundell-Fleming model, the monetary model assumes that output is fixed and that monetary policy affects exchange rates through its impact on prices and inflation, not through interest rates and GDP. So there's a subtle difference there. This is almost pure monetary theory here. And so this goes back to Milton Friedman. Milton Friedman, and I'm paraphrasing here, said something like, inflation is always and everywhere a money supply issue. But this should make sense. So a relative increase in the domestic money supply causes its currency to depreciate. That should make perfect sense. So that's what I like about this. This is the old Milton Friedman, and this is telling us that, okay, these things back here under the MF model, these are important, and I think these are very helpful. But we can also add the importance of the money supply, which of course is controlled by central banks, causing currency to depreciate and appreciate. And here, this is super important. Comma. You ready for this? Over the long term. Remember, our goal is not to predict exchange rates over the short term, because we know that that's an impossibility. But over the long run, we have a chance. The Dornbusch overshooting model frees us from some of the limitations of this pure monetary approach model. So let's go ahead and look at some of these freedoms. Short run prices are fixed, but in the long run, that those prices are fully flexible. So this is a little different than what we did back in that previous page. And so an increase in the money supply over the long run, are you ready? Domestic prices will increase, making the domestic currency depreciate. So we agree there. So Dornbusch and the MF model and the monetary model, they all agree with that over the long term. But under the short term, boy, look at this. Exchange rates overshoot. They overshoot. Now, in the finance literature, going back to the 80s and the 90s, they call this overreaction. Overshoot. Okay. Yeah, let's go ahead and look at this portfolio balance approach in the short term, which is in green, and then the long term, which is in red. So if we have this expansive fiscal policy, there's going to be an increase in the real interest rate differential, and that's super important. And that's going to lead to currency appreciation in the short term. But that's also going to result in, of course, government, expansive fiscal, so government spending. So we're going to have lots of debt. Sooner or later, the central bank is going to monetize that debt. Think the U.S. and Fed these days. Sooner or later, fiscal stance turns restrictive. Doesn't appear to be happening in 2021 in the United States, and then we'll have a currency depreciation. So I think this slide and this LOS is an illustration of what we've been talking about in terms of what might happen in the short term and then what might happen in the long term. Remember, our focus is in the long term. All right, how about government intervention? I remember I had a professor in college who said something like, whenever governments start intervening in the markets, you know that something's going wrong. And I'm paraphrasing him there. So sooner or later, governments get involved because that's what governments do. So there are push and pull factors. So think about pulling in. So how are we going to pull into our to our economy from the outside global world, right? Well, let's suppose that I'm Jim and I have an exchange, and on my exchange I have all these rules. I say, look, if you want to come, you have to buy 12 shares of stock. You can't buy 20, you can't buy 30. Whatever you do, you have to trade in 12 shares of stock. And if you want 24, you have to wait an hour, okay? And you're not allowed to borrow any money when you show up at my door to my exchange. So no leverage no outside leverage is possible. And then you have to go through these servers and you have to go through these inputs and this supply chain to get to my market. And plus, you have to wear flip-flops to trade on my exchange, right? So think about all those restrictions. So liberalization of financial markets, what would that mean? That would mean me coming to the exchange one day and say, you know what, I'm open. Anybody come on in. You can trade as many shares as you want. You can leverage. You can wear whatever you want on your feet. So liberalization of financial markets. And then, of course, when the sovereign debt is upgraded, which can't happen in the United States, but it can happen all the way throughout the world, upgrade, boy, that's a pull factor. As opposed to push factors where we're being pushed into that foreign market. And a lot of times this is the result of capital being mobile, and capital, boy, remember what we learned back in our original economics days is that capital will flow to its most efficient resource or its most efficient use, right? So if we have this money to invest and we have a domestic portfolio, we have a global portfolio, but we don't have anything invested over there, we're being pushed to say, okay, let's figure out what's going over in that country, and we have mobile capital, so therefore we can so look what we have in parentheses. Investors in industrialized countries, and then the long-term trend in asset allocation, meaning that we're trying to find assets and securities out there that have low correlations with the domestic markets. All right, we want to make sure that, I'm thinking as a government person, right? We want to prevent currencies from appreciating too strongly. There's always a problem when the value of a currency changes dramatically from one direction to another. But appreciation too strong and too soon, that causes problems as well. Reducing the aggregate volume of capital inflows. We need to make sure that that capital is coming from wherever those people want it to. And then independent monetary policies. All right, that makes sense. All right, so what are some interventions and controls? Allow currency to appreciate if it's undervalued. Intervene in the foreign exchange market if overvalued. So here, sometimes the government is going to act. And what did I have back here? I don't think I mentioned this. So direct intervention. So that's the second part, direct intervention. But notice that first one, allow the currency to appreciate if it's undervalued. That means just, kind of step back and say, okay, you guys figure it out. Expand the monetary base. Okay. Sell securities to take care of excess liquidity and institute capital controls. Now, government interventions and controls, they ought to be, notice what we have, we put the word should, they should be useful in terms of decreasing the aggregate volume of cash influences, allowing monetary authorities to adapt those independent policies, and preventing excessive appreciation in the currencies. And I think we've hit this last one here. What are the warning signs of a crisis? So this, in my mind, this is a great question 6 for a vignette. So you've done all this work, you got all 5 of those questions correct, and then the last paragraph, or maybe a middle paragraph in there, says something like, okay, here's a country, inflation's higher, we're not exporting very much, decline in exchange reserves, Currency values are way above its historical, et cetera, money growth, banking crisis. Okay, so yes, the question then is this country have a higher or a lower potential for a currency crisis? So look for these. Take a picture of this one right here as well, and answer that sixth question like that. You don't want to spend 5 hours on question 6. You want to get that and move on. All right, so there we go. Those are the LOSs, 2 pages of them. And so I'm going to not pick out one of these that's super important. I always tell you to be prepared for the calculate LOSs, because the calculate ones ought to be the relatively straightforward, you can get the correct answer. But I like this concept here of worrying less about short term and worrying more about long-term predictions for exchange rates so that we can help our clients.